Thank you to all that will be joining, whether in person, in spite of the weather, and those that are online. I want to give a special thank you to Frank Arnstein, Bitbean, for hosting us here tonight. It's a special relationship that I share. My name is Ira Group. 18 years ago, I founded Eastern Union, one of the largest commercial mortgage companies in America. I'm humbled that Eastern Union in the last 3 years closed $12 billion of commercial mortgages. I've learned a lot of it over the years on the ins and outs of commercial real estate and getting investors most favorable terms. Before I begin, I just want to give one disclaimer. I'm not an attorney, I'm not an accountant, I'm not a financial planner, and anything you hear tonight is just from a layman telling you comments what I've seen in the industry. If you want to get involved in lending in any part of the process, my advice to you is get an attorney, get an accountant, get a professional, a financial planner, advisor to give you advice. There's a lot of legalities in the process here, from securities laws, real estate laws, and you want to make sure that you're protected and you're covered. The Ira Group, what do we do and how we make money? So the Ira Group educates people on the benefits of lending. Technical problem. Now we know we're human problems on this live stream. Good. This is very exciting right here. We'll take a brief time out. On the screen, that is. Okay, to resume. I recently formed the Ira Group to focus on a completely new aspect of the business. Ira Group educates people on the benefits of lending on commercial real estate. We show how with as little as $25,000, someone can choose to participate in a loan, choose their level of risk, and earn 4%. Someone else can choose to participate in the same loan with a higher level of risk and earn 8 to 12%. The loan syndicate on the deal can earn as high as 70%. The key thing that I want to be able to show here is that when someone buys a commercial piece of real estate and they go in and you want to invest with somebody, they buy a building, let's say for $1 million. There's a loan for $750,000. If you participate, you're participating in the riskiest piece of the transaction, from $750,000 and a dollar up to $1 million. If there's a mistake in that building at all, it goes down by 10%, you lost your money. The benefit is obviously is that if it goes well, which most real estate deals, most of your stories are successful stories, real estate goes up in value, you can make a much higher return. By lending, the benefit that you have in lending is twofold. Number one is, aside from the fact that it's a first position mortgage, is that let's say you sit in a room here and you could ask people, what do you think is going to happen to real estate over the next year? Is real estate going to crash? Is it going to correct? Is it going to stay? Is it going to go up? Everyone in the room could have a different answer. You could think it's going to go down 10%, 20%, 30%. In that same transaction, the person that thinks real estate might go down 30% even could decide, you know something? It won't be worth $1 million, it'll be worth $700,000. Let me lend $650,000. I'll still have a cushion. If there's something goes wrong, I'm still protected. Someone else could say, you're being very conservative. I'm willing to lend it for $700,000 or $750,000. They could pick the levels of risk on the whole loan. The added beauty is you could decide to participate in that loan at the safer level of risk. So you could have this market, you think the market's going down 30%. Someone else thinks it's going down 10%. So basically, someone thinks the real estate market, I'm conservative. It might go down to 900,000. Someone else says it might go down to 800, someone else 700. I'm a risky guy. I'm going to make a loan for 90%. I lend someone $900,000 on a $1 million building. In that scenario of going down, lend the person $900,000, I say, you want to participate in my loan? He said, I think you're crazy. You put up $900,000. I think the amount will be worth $700,000. So I can say, okay, you could participate. I'll give you back your money first. And your money will be protected in the first part of the loan. So the beauty of lending allows you to decide the level of risk that you want to take. It's not all or none. When someone buys a deal, primarily it's going to be a case of all or none. Someone bought a deal for $1 million. If it goes down in value, everyone proportionally lost on that going down in value. And we'll talk about the details of that later on. The second thing that we do is basically that the Ira Group is basically like hard money brokers. But when you think of a broker, you typically think of someone with a building that's looking for a mortgage. That's the work that Eastern Union does. What the Ira Group is going to do is going to introduce individuals that after such a presentation say, hey, I would like to participate in loans. So you don't have to participate in the Ira Group. I'm not taking anybody's money. What the Ira Group is doing is that if you decide you'd like to participate in a loan, you could tell us the level of risk that you want to participate in a loan. And when a lender tells us, hey, Ira, I'm making a loan now on this property, this loan to value. Do you have anybody that wants to participate with me? And that matches your profile that you set up, we can make those introductions. But even more importantly, you could take the information you take today and you walk out and say, I want to get involved. You don't need the Ira Group to help you. You could have now seen someone in your community that puts money up in real estate deals, lends money and say, hey, can I participate with you? I never realized I could just take the safest piece of the loan or the riskier part with you. Or you have friends who do fix and flips and say, hey, they're buying a house for $100,000. You want to lend them a certain amount of money at a higher rate and you feel comfortable with the people involved. So the goal here is to educate on one end of it, standalone, nothing tied to it. And number two, if you wanted to participate, we'll make introductions to lenders. The people who pay in this field are not you, the participants, it's the lenders. The lenders pay to be able to find them different sources of capital. I want to go with one storyline here. And I'm going to go through the whole webinar, and I'm going to go through one basic case study, an easy case. The numbers have no resemblance to reality. It's just for illustration purposes, and I find it's easier to follow if things stay with the same theme throughout. So we're going to go with a property type of a cash flowing apartment building that has regular rental income, regular cash flow, it's regular stable building, everything is great. The purchase price is $1 million with $50,000 in closing costs. So the total cost to do a transaction like this is $1,050,000. The net operating income, for those that are new, NOI, is an important word in real estate if you're getting involved. But as far as if you're not in real estate, to keep it simple, it's basically the profit of the building, the cash flow, the profit of the building. Here's a building that has $70,000 in profit of the building. In this case, Larry, in this case, we're going to use the story throughout. Larry will be the lender, and Brian will be the borrower. So just, I know for myself, I'm terrible with names. So I figured Larry, lender, go put together, and the buyer is Brian. That's how I came up with going from there. So hopefully it's the same ease of use for you. So now let's talk through the scenario here. The first method, how people bought real estate before mortgages. Go back, I want to bring you back to the beginning of time, how people dealt with real estate, and bring you all the way up to this lending on a pretty quick pace throughout. Brian purchases the entire property on his own. Buys a building, $1,050,000 is the total cost. He writes out a check, there's a wire for $1,050,000, and he takes the deal. The second method is Brian takes in partners pari passu, which basically means in this case is that he takes in even partners, that everyone shares the risk evenly. It could be that one person puts in 10% of the money, one person puts in 40% of the money, but if there's a loss or a gain, they evenly share in that loss and the gain. For today, we're going to use an example of 4 even partners. Brian takes in 3 partners to go together, and they come into the transaction, each put up 25%. The reason why people would go deals even and not go even is because typically if you go back to the generation or 2 generations before as they bought real estate, the way they typically bought real estate was either totally by themselves, or if they didn't buy by themselves, what transpired instead was that there was a group of buyers, 3 or 4 or 5 buyers, and each would look for deals. Whoever was successful finding a deal to buy, they brought other partners in, and that's how they always did business together, was on a partnership, doing different deals in different marketplaces. The third method, which is the most common method today, across the board in all types of investing and lending and everything, is called syndication. Brian syndicates this transaction. The same people. The difference of number 2 partners is that he makes a deal with the partners and says, listen, you put up the same money, we put up even the same amount of money, 25% each. But after you see a certain return on your money or whatever the details are of the negotiation, each participant gives up part of their piece of the profits to Brian and say, listen, you got my money back, I got the returns I'm looking for, I'm fine to take some of the profits. So now I want to go through here before syndication, just to show you graphs, you see it on a visual a little bit differently. Brian and each of his partners put up $262,000, 500. That's 25% of the $1,050,000. Now, since the building has a net NOI, net operating income, against the profit, the cash flow of 70,000, their return on investment works out to 6.66%. So without taking a mortgage, buying a building all cash, in this scenario, they each make 6.6% on the building. They each own 25% of the deal. After syndication, Brian and his investors each put up $262,000. This is the same scenario, but if you're using a syndication example, they put up the same 25%, $262,000, $1,050,000. Instead of each person taking, each of his partners getting 25% of the deal, they each get 20% of the deal, and they give 5% to Brian in exchange for taking care of and overseeing the whole entire property. So in this scenario, Brian ends up with 40% of the deal by putting up the same 25% of the money that he had to put into the deal. He ends up with 40%, and each of the partners end up with 20% of it. Each of the partners end up with 20% of the deal. Now, if you look at the numbers here, because they gave Brian a little bit extra of their money, Brian's return on investment, Brian's ROI went up from 6.6 to 10.6. Well, all the other investors went down from 6.6 to 5.3. Now, obviously, if you had a choice to invest with someone evenly, or as we're syndicating the deal from you, obviously you'd rather go with the example before. But you don't have the choice. As an investor, you sit there and people bring you different deals. And each deal has different terms and structures, how it's structured. You're going to invest at that time with the right person on hopefully the right deal and how you want to structure your deal and be able to go ahead and move forward. Now, buying real estate with a mortgage. Brian and his partners take a mortgage for $750,000. In this case, 75% of the purchase price. And they have to put down, and usually the purchase price and loan and the values are usually the same thing. So let's keep it simple, $750,000. I'm giving you an example that's not typical. I'm giving you an example that took an interest-only loan, where they took a loan where the bank says your interest rate is 4%, and which works out to a $30,000 payment. You don't have to use a mortgage calculator to figure this out now, so it's very easy. $750,000 times 4%, the payment's of $30,000. Most banks, just like on your home mortgage, make you take a 30-year payment plan. You have to pay down the loan over 30 years. They might give you an interest only for 1 year, but this, for the purpose of this illustration purposes, I just want to give you an example here and just don't think this is the norm. So, because the rest of the numbers start becoming a lot different because it's interest only. But in a simple case here, they now bought the same exact building. The difference over here is that because they only put up $300,000, the $250,000 between the purchase price and the mortgage, plus the closing cost of $50,000, they put up $300,000. They now have a $40,000 profit. There's a $70,000 with the NOI before, minus the $30,000 to the mortgage. They have $40,000 left over. That $40,000 they've left over more than doubles their return. Because if they have a $40,000 return on a $300,000 investment, their return just went from 6.6 to 13.6. This is the power of leverage. We can go through later on how the negative of leverage works exactly the opposite in bad times. But in a simple example over here, by taking out a mortgage, because they found a bank that's willing to make less than the building was throwing off, and they kept the spread, they kept the difference of the 6.6 to the 4, and they divided amongst themselves, their return went up. So I didn't go through another breaking out the example, but the same concept is the above is using a partner example. On a syndicated deal, the ROI for Brian is even higher. So just like on the original deal, when Brian takes without a mortgage, and he takes in partners, and he syndicates it out to partners, the first part of the partnership that he takes goes from the first part of the partnership, he goes from 6.6 and he goes higher, and all the partners go less. Same thing will happen here. If this was a syndicated deal, he would go up to above the 13.3, and they would go below 13.3. What are the benefits of taking a mortgage? The benefits of taking a mortgage is that Brian can now, if him and his partners had this $1 million, they can now really, with a mortgage, buy a $4 million property. Take out a $3 million loan, buy a $4 million property. So they can buy a bigger property with the same amount of money. Or Brian really maybe could have swung it himself. Maybe he had a little bit more. He had $300,000, not just $262. Could have bought the whole building himself. Or, like we saw with the mortgage, simply put, whatever level you go in at, if you take a mortgage, you're able to leverage up your return. You get a higher ROI, a higher return on your investment. The risks of taking a commercial mortgage. This is, in my opinion, the risks of owning real estate, is if you take the wrong amount of leverage. So if you're a borrower, as much as you, when a client calls me up and says, Ira, looking to take out a loan, how much you're looking for, the most I could get. The risk, these are the risks. You take out the wrong mortgage, that's what caused the financial crisis in 2007. It didn't happen on commercial real estate, it happened in homes. People took crazy adjustable rate mortgages, all the different types of loans. So here's the risk of taking out a mortgage. You have the building, vacancies increase on your building, rents drop, or expenses rise, you may not be able to live up to your debt service coverage ratio, DSCR, which can trigger default. This is a key piece of the business here. When you buy a home, the bank wants to make sure you can afford to make the mortgage payments, and you have enough money for a rainy day, for other expenses. The same concept works on a building. The bank says, not only do I want to make sure you can afford the $30,000 that your payments are, and the building itself could afford it. I don't know you're getting your money from some other source. The building has $30,000 in NOI and profit. I also want you to have a buffer. The buffer that they're going to want is a buffer of typically around 25%. They're going to say, aside from paying us $30,000, you have to have 25%, which is another $7,500 in total NOI. You have to have a deal with $37,500 on this deal in order to take a loan from us. In this case, it's easy. You have $70,000, a big buffer. But what happens if through the process you lose tenants? If something happens to the building, the rents go down, you run into different issues. I just want to comment on that. I'm going through the whole presentation, and then I'm going to take the questions after. So this way, those people that are opting out, there's a few hundred people that are online, I'm going to deal with it after. So the debt service coverage ratio is a very, very important piece of the puzzle. Not only do you have enough money for the debt service, the mortgage payment, you have to have a ratio, a buffer on top of that. So if you don't have it, you could be paying your mortgage, you're in default. That's problem number one. Problem number two, even if your projections are on schedule, a bank on a commercial property, when they make a loan, they don't give you a 30-year fixed rate mortgage. On your home, you have a 30-year fixed rate mortgage on your home. On a commercial piece of property, when I say commercial, in apartment buildings also, they give you like an adjustable rate. It's a 5, 7, or 10-year adjustable rate. I'm not going into it now, why that works that way. This is the facts of how it works. So 99% of every commercial loan, the person who took out the loan within 5, 7, or 10 years has to either refinance or with a new bank or the same bank, or they stay with the bank, but the rate changes automatically. So the issue is all about timing. What happens if the day your loan comes due, the rates spike up? So today, while I'm giving this seminar now, the last few days rates dropped. So you had a loan that today you had to reset your rate, you're the happiest person in the world. But just as well, it could be the opposite way. What happens if today is the day that it pops up? What happens if today people start frowning on different areas of real estate? And they say, this building's not worth $1 million anymore. This building's worth $900,000. He's ready to carry it longer. Doesn't want to sell now. But the bank says, I'm sorry, we don't lend 75% anymore. We're nervous about real estate. We're lending you 70% of the $900,000. It doesn't have enough to refinance the $750,000 in this case. So what happens at that time? If he could come out of pocket, which means if he could say to the bank, listen, the new bank is lending me $700,000. I have another 50 in my pocket. So he goes to the old bank and says, here, let me give you back $750,000, $700 of my own money, and he's fine. But if he doesn't have that, the building goes into foreclosure, the bank sells the building, and the issue is that when the building gets sold, going back to the perks of lending, the lender gets their money back first. The reason why the lender gets back the money first in the economics of the deal is that the lender that's making this loan made this loan, all they got is a lousy low interest rate. If it's a hard money, it's a little bit more, but they got an interest rate. They can't make more than the interest rate. They can only lose. If God forbid they banked wrong, they thought they were safe. Let's say something goes wrong with the loan. But an investor is the opposite side. Very easy to lose money, but he has unlimited upside. So the key over here is that these are the risks of taking a mortgage, in my opinion, is the timing. If you took the wrong leverage and the bank has the ability to call you up, or you can rents go down. You can't afford to make the monthly payments that month. You could trigger problems. But I want to explain to you one major point. Most commercial real estate owners are not liquid. Their money is not like in a stock. Their money is not in the bank. Every time they have an opportunity, if they have cash, they're reinvesting their cash either in their current building to bring up the value and increase the rents, or they're buying a real estate. They say the story, Warren Buffett was going to buy a couch. His wife, they want to buy a couch, and they said the couch cost $600, and he says, no, it doesn't. It costs $42,000 because if I put the $600 in my funds for the next 40 years, what will it turn to? So they always take that approach. But here's where the problem is because of leverage. If real estate, we started it before asking, what do you think is happening to real estate? What's your opinion? 10%, 20%, 30% stay the same. If real estate just has a slight correction, 10% correction, that means this building is no longer worth $1 million. It's worth $900,000. The real estate people in the deal lost more than 50% of the net worth because they bought this for $1 million plus $50,000 closing costs. That's $150,000 they put above the $900,000. They put $150,000 below. So right away they lost the top piece plus some closing costs. And maybe they were carrying it before they decided to sell and walk away. If real estate corrects by 20% or 25%, a real estate owner is wiped out to zero. So it's not like a normal case. You hear the stock market crashes by 10%. Most people don't have their stocks leveraged. you have $100,000 worth of stock and it goes down 10%, you lost 10%. When you're buying real estate, you're all leveraged if you took a mortgage out. Because you own $1 million building, but you have a mortgage with 75% of that. Your piece is just the top. It gets wiped out, it goes from there. So that's the buying, and that's why you meet people as skeptical in real estate, because you have to be comfortable with two things in real estate. You have to be comfortable that the deal is a good deal, and what do you know about a deal, and the research on a deal. And the second thing is who are your partners. So maybe do you trust this person, does know what he's doing? So you can have a great building, this guy mismatched, has no idea what he's doing. I'm not still my trust as far as honesty. Let's assume the guy's honest. Does he know how to manage properties properly? Does he know how to deal with these issues? Let's talk about who are these lenders. We talk about lenders all the time. Who are the lenders? So the first group are savings and commercial banks, which basically keep it simple. When you what you're accustomed to when you think about a bank, you walk into a branch, there's tellers there. They're either chartered as savings banks or commercial banks. There's Wall Street, which is CMBS, commercial mortgage-backed securities, life insurance companies, credit unions, Fannie Mae and Freddie Mac. Not relevant to know all the mechanics of each one. As far as we're concerned for this presentation, they're called banks. The second part is called hard money, bridge or private lenders, and it's hard money lenders. There are three words that get intertwined, those three examples. It's really, typically, it's a private person. It could be a mom and pop person, it could be someone very wealthy. It could be someone that opened up a company as a lending company, and that they go together and they do private loans, bridge loans. But the simple form what they really are they're bridge lenders, which imagine if you would, you have two islands. You have to go from here to here. How do you get there? You build a bridge to go over. A bridge loan is when someone goes out to a bank, they call me and say, Ira, could you get me a loan? I say, no bank wants to lend you money. Whatever the story is, we'll get into examples soon. In that scenario, I have to find me a bridge lender. Would you find me a private lender, a hard money lender that will give me a loan from today until I'm ready, a bank will refinance me. So the classic example, and it has the lowest rate, is a construction loan. I have a vacant piece of land. No bank is really like to lend on land, and they have to get to a stabilized property. We'll do a construction loan. Construction became such an accepted business, so to speak, that even though it's really not cash flowing, construction became banks do construction loans. But outside construction loans, that's a bridge. After that, every other type of bridge loan you could possibly do starts getting much more expensive, all the way up to what we call hard money rates. They go to the 12%. Now, I want to flip it. What are the risks of lending? It's the same concept. Now, even though the loan is a first position, so you have to remember, ultimately, your first position when you do a loan. So these loans are first position, they're recorded, you have an attorney, you have title insurance, the whole gamut. So you're protected whether you're a bank or private lender. It's not just unsecured. Like a lot of people when I was putting out the webinar said, we do this merchant lending as if, what I'm discussing here is real estate. It's first position real estate. But even so, if the borrower can't live up to the lender terms of payments due to unforeseen issues, such as market conditions or environmental issues, you run into a problem. You're officially in default. The bank and the lender has to spend time and cost to work through issues. They could maybe by mistake do a loan, there's some fraud involved. These are risks that you have. In a very overwhelming cases, banks don't at the end of the day lose money if they underwrote the deals right. They're showing commercial real estate. I think that in all the years, and in preparation, I called several chief lenders just to like double check from their perspective as well, because I could be doing just maybe a certain area geographic of the country. In my career, I never saw a loan that was made at a 60 to 65% leverage ever go sour. The bank took a loss. Did they go into default? Was there a fight? An issue came up? The owners got divorced, got into a fight with the partnership. Something went wrong. But at the end of the day, when the movie ended, when the building was sold and all the money was counted up, the bank got back their money, and in many cases, even the interest to carry throughout the course of the process. So just to put all these things in perspective, to understand lending, that's the benefit of lending. Where do you think correction is going to go? The reason why, by the way, with trillion, I don't know how many millions of homes that they did over the years, how many millions of different, so tens of millions of different mortgages that take place. Statistically, the reason why banks feel comfortable, as we're going to go move on, to go to 80% on apartment buildings, where they lend to, what do they call 80% on apartment buildings and homes? It's because the reality is when there's a problem in the market of apartment buildings, from the value of today of the loan you're doing today, if there's going to be a correction on average, it's not going to drop at more than 20%. That's why they're safe. So if they just did a loan this morning, rates aren't tomorrow, values won't drop by 20%. If values drop by 25%, it could have been based on the high of something that they put out a loan 2 years ago, so the balance is not the same. But there's a reason why they're comfortable at 80%, because they're not taking losses. You don't see banks closing down every single day. To the contrary, they're making money. So outside of banks doing loans at 80%, on commercial properties, they want to be a little more conservative, because it's not as easy. People don't have to work. They can work from home. You have to live. You need a place to live. So therefore, They want to be a little bit more conservative, so banks deem 75% to be safe. On a story, non-typical, they get nervous, they drop down to 65. When I call up a lender to have a very conservative loan for you, it means I have a 65% loan to value for you. That's deemed to be a conservative loan. How do typical banks work? How do they work? They take money from depositors, which typically pays 0 to 2%. That's us. Each of us have a bank account. You have a checking account, a savings account, a money market account. Your bank is paying you on your money somewhere between 0 and 2%. The bank takes that money and lends it out. That's what they do. They take your money, they lend it out, and they keep the profit. It's a very simple business model for a bank. And if you really think about it, there's nowhere else in your life you give someone your money, such a cheap rate, and let them lend it out, and say, don't worry, trust me, and let them keep all the extra profit. The only reason why we do it is because there's something called the FDIC insurance. The federal government is insuring the money and saying, it's safe. Your money's very safe. We're going to monitor the bank, and it's like an insurance policy. If the bank messes up or closes down, we'll cover your money. There's certain rules and regulations, but that's the reason why we do it. We're giving the banks our money at 0 to 2%, so they can lend it out at 4 to 6% or higher. And you don't hear stories of nightmare stories, foreclosures happening all day. Definitely not in the commercial space. Even in that market in 2007, 2008, it wasn't commercial loans that had a problem. It was residential market that triggered everything. So because the FDIC insures this money, the FDIC regulates the banks and says you can only do an uber safe loan. You can't take risk on our money. In order for them to go do the uber safe loan, they say lend on a stabilized, cash flowing, income producing property. Like the building we're describing here, an apartment building, cash flowing, everything is great. So not only is the value good, but the debt service is good. Have double layers of protection. Have a minimum debt service coverage ratio. You could afford to make the payments. Plus, is a loan to value not going to go above this threshold. You need time to do underwriting. You can't just like walk into a bank and close instantly. That's a due diligence on you, on the borrower, the whole process to take it through. They have no interest in owning the property. And there's a key thing to understand. They just want their money back every month, on time, and at the end of the term. They're not in the business of owning real estate. So I once had this client who had a loan with the bank, a $20 million loan. He was selling the building for $60 million. And he was all like, he didn't pay his bills on time, and the bank's calling me, screaming and yelling, and Ira called this guy up. The guy said, what does the bank care? They charge me a huge penalty every month. I'm paying it. They're making fees. So it doesn't work that way. The bank is in the business of making loans. If you don't pay them on time, they don't look at, oh, there's not a problem because it's worth $60 million, the loan's $20 million. They know they have to report to regulators that they have a loan bad on the books. It's a $20 million loan. The regulators don't look at the loan to value. They look at it, oh, you have bad loans on your books? What percent of your loans are bad? They start giving them a penalty and not giving them the same flexibility to put out other loans. So that's a key thing. You're going out to a bank. That's why banks do a lot of due diligence up front. They want to make sure they're not going to have a problem. You're going to pay me every month, pay me at the end of the term, and on top of that, just in case there's a problem, we could sell it, it's worth it. And that's why they also take personal guarantees many times. And just in case, with strike two, the cash flow goes away, the value drops, we take a loss, we're going to want a personal guarantee from you in order to go ahead and move forward. Now I want to shift, as we move to hard money lending, I want to tweak the story a little bit differently. Okay, so this is the important page that's going to set the tone for the main part and the main thrust of what you're going to be able to walk away with. This building, instead of being a completed multifamily building, it's a partially completed building. It's a full building, but it's not fully rented. He has to fix up some of the apartments. Maybe it could have been an old fire in the building. He's taking it over. The purchase price is also $1 million, but there's $200,000 in this building that he has to do in renovations, closing costs. So the total capitalization, the total cost to buy this is $1.2 million. The projected NOI, the projected profit, when everything is rented up, it's going to be $85,000. So this deal, when it's rented up, will be worth more than $1 million too. Seems like a good investment. Everyone's happy, and they go on. And here's the key pieces of the puzzle. Brian is the buyer, same Brian. And there's a very important piece. Obviously, you could take a pun from the Eastern Union plug in here, but the Eastern Union is the mortgage brokers as follows. When someone is coming to take this loan, they're not looking for a hard money loan. Someone doesn't call me and say, Ira, could you give me a 10% interest rate? The person calls me up and says, Ira, we have a relation with 100 banks. Is there one bank that has an appetite that even though my building is not fully rented, you could bring me the deal? And we could start with finding a bank with a good story. Maybe the guy's strong enough to guarantee it. Maybe there's a bank that, on apartments will be a little more flexible. And ultimately, we go through the process. His last resort is going to be typically a rate that's a double-digit rate. That's his last resort if everything is even. Usually, everything is not even. It's either because he couldn't get it, or he could get a better rate sometimes, but sometimes he bought the building because he has to close fast. So he has a loan. I get him a loan, but it's going to close in 60 days. He goes, you have something that will close me tomorrow, next week, a hard money loan? I'll take the hard money loan. So I find him in this case, the same Larry that's going to be the lender. Larry does a loan for him at $700,000, a hard money loan, comes in at 70%. He charges him a 12% interest rate and 2%, 2 points in fees. He charges him a fee of $14,000 as the lender to go do the loan. This is in addition to any other closing costs you have. Now the loan is going to start. What's important before you go through to the rest of this presentation? It is irrelevant and not really important to Brian where Larry gets the money from. The reason why Brian trusted Larry is because Larry shook Brian's hand and says, I will close, and the day after close, these are my rates and terms. You won't hear stories. Just like you went to the bank. The bank doesn't tell you, oh, I'm lending you $7 million. Let me tell you which accounts I'm pulling it out of. They don't tell you that. Just go into the bank, you trust them, they're going to close. Same thing works here. So everything I'm explaining from this point going forward is behind the scenes. Is a conversation that either I could have with Larry behind the scenes or Larry has on his own with a pool of investors that he gets to participate in his loans. So the starting point is, where does Larry get the money from? Same way, he's a rich guy himself. He writes out a check for $700,000. He has partners. He finds loan participants. He finds people just like a syndicator. And he says, would you like to join me evenly? Or the case like before, syndicates the loan. He goes out to 13 people, 6 people at $100,000 each, goes out to 13 people, $50,000 each. He puts up $50,000, puts together $700,000 in any denomination that he wants. And he will tell them, hey, I'm getting a loan. I'm going to keep the points. I'm going to keep the fees. I'll keep some of the interest rate. I'm collecting 12. I'll pay you 10. I'll keep something in the middle. He'll work out a deal with them, and he'll go ahead and make a loan. The third piece is really where the eye-opener for me was in this whole presentation, is A piece and B piece. I'm going to get into it after we go through the steps to build up to that scenario. Let's break down the point of a hard money lender. They can close faster than a bank, number one. It's a person. I like this building. I'm going to do it. And it's a very important piece of this to understand. Many hard money loans on the larger real estate deals that go down are typically, or very frequently, the person that lost the winning bid now puts together the loan for the person who won the bid. So there was a huge transaction went down. It's $1 billion transaction. The second bidder in that transaction was comfortable that he would have bought the building it went for like $1.1 billion. He would have bought it for $1 billion. So he put together a loan for $900 million, put up his own equity, would have put down if he was buying it, went to a bank and said, hey, let's together make this loan. They made a loan because it was, he knew he was prepared to own it at $1 billion. So he knew this is a good deal. I know we're not going to have a problem. I'll make the loan. If there's a problem, I'll take over the building. Didn't intend to take over the building. So the difference is they can close faster than a bank because it's private people doing at whatever speed they want to do. Get clean title and you're done. They bridge you from where you are to the point when a bank will refinance you. Like I said, they're bridge lenders. They lend on assets versus cash flow. They don't need a cash flow property. They can live on a total vacant building, a piece of land. This building is worth $1 million. You're buying it for $1 million. I don't care if it's vacant. I'll still lend you $700,000. And I make that decision. They're not regulated, so they can do things bank cannot do. But often the risk is even less. In my opinion, watching the scenario, and I could put the question out there, I think that in this loan, that taking a $700,000 loan on that building is a safer loan than the bank that's going to do the refinance when the guy builds his building. The guy's going to take his building, fix it up, rent it up, probably get the market rents across the whole building. Beautiful building, top of the line, rent it up, he's going to get the best valuation, and the bank's going to lend him 80% of that valuation. A little correction in the market at that time, the bank's in trouble. Today, on the other hand, you look at this loan, guy's going to a loan for $1 million purchase, about to put in $200,000 to fix up the building. I'm lending him $700,000. It's a very, in my opinion, I'd rather be in the second loan versus the first loan, if you have that option to go from there. They prefer to be paid, hard money lenders, but are prepared to own, different than a bank. A bank does not want to own, does not want to be in the business of owning. That's not their strength. A hard money lender is willing to own. You have the negative stereotype, you go to, people who sell cars, so they have a negative car, you have a negative stigma when they say used car salesperson. Hard money lenders is like lend to own. You're just lending me because you want me to get in trouble and take over the building. That's not really the business. Hard money lenders aren't in the business of lending. If their reputation is like lend to own, they're not going to be in the business of lending. They can do it once or twice and they're out of business. So a lot of people have this misconception. Who would pay 12%? If a deal's so good, why would someone pay 12%? Because a person bought a building at auction. They have to close in 2 weeks. it's half baked. You can't figure out the whole story. Yeah, a hard money lender. The guy who lost the bid, if he's a lender, will lend you 70% of what you're paying for. The typical hard money lender terms, many only go up to 70% loan to value, lend at 9 to 12% interest rates, 1 year term, and they charge about 2% fee of the loan amount to do the loan. Here's how the math works out. Before A-piece and B-piece lending, Larry lends Brian $700,000 for 12% interest and 2 points. So Larry lends $50,000 of his own money, let's say. This is arbitrary. I'm using this as an example. Larry goes out to 13 friends and say, do you want to participate with me? Each of you put up $50,000, $650,000 combined. If my money would even for $700,000 loan, and you'll get 10%. I'll keep the spread. I'll collect 2 points as my fee. I'll collect 12% interest rate. I'll pay you 10. I'll keep the difference. If you look at the math, he collected $98,000 made in points and interest. So 700,000 times 12% is $84,000. 2 points is 14,000. You're in for 98,000. $65,000 gets paid back to the loan participants, and 33,000 is profit. So here Larry made a loan which is deemed to be very safe, 70%, and he earned a 66% return on his money, because by leveraging up and syndicating out this loan with these spreads, these are the amounts of money that he made. So let's take it a little bit to the next level. What is A-piece and B-piece lending? Okay, A-piece and B-piece lending is that instead of Larry and his participants putting the full $700,000, Larry will break up his loan into an A-piece and a B-piece. Think of it as a first and second mortgage within the same loan. So you will think of a first mortgage and a second mortgage. I have a second mortgage on my house. Over here, it's behind the scenes, like I said before. Larry, behind the scenes, went over to a bank and said, listen, why don't we go together do this loan? You could never lend this guy $700,000. But the mechanics, by the way, and it's not relevant if you don't understand it now, but I put onto the slide here, is the banking mechanism is structured as a note-on-note financing. So we're calling it AB, so it's simple to relate to. Is actually technically who the borrower is, how it works. But let's keep it simple how the transaction goes. The bank is lending the A piece. The bank is like a first position. He goes to the bank, listen, you can't lend $700,000, but you could lend me, Larry, I'm making a loan, chip into my loan with me at a very, very safe place, 50% loan to value, number one. And then I'll put in $200,000 behind you. Together we'll do a loan for $700,000. So in my humble opinion, it's the safest loan for a bank. And one of the things I'll be pushing to a lot of people that should try to do if they want to be safe instead of money sitting in the bank is participate in the A level of a loan. Because if you think about it, someone bought a building for $1 million. Two people have to be totally wrong for the bank to take a loss. The guy bought it for $1 million, putting in money, thinks it's going to go up in value. He has to be so wrong that within his 1 year of buying this building, it's a 1 year loan typically, the building goes down below $700,000. He's knocked out. Not only that, the lender also made a mistake. Larry was comfortable lending him $700,000. He also made a mistake. He's wiped out. And the building only sells for $500,000. What's the odds? Like I said, I never saw a deal 60%, 65% with the bank took a loss. 50%, it's like, there's no, in my opinion, again, that's why I gave the disclaimer before. For me, that's the safest thing. Almost sight unseen. Someone tells me that they're dealing with someone who knows real estate, the building's worth this price, they appraised it. Could you lend the person 50%? It's like, think for yourselves. You live in a house. Let's say your house is worth $500,000, $1 million, or $5 million. The house right next door from your house. Someone's buying it and says, hey, can you lend me money? How much would you lend that person the money and know you'll always get your money back if it's the first position? Is that $500,000 house next door to you going to drop to below $250,000? That's what it means, 50%. So over here, it's an A loan and a B loan that gets put together. The A loan and B loan gets put together now is that the borrower now gets the same one loan, $700,000. But behind the scenes, the bank gets the money back first, and all the B department gets the money second. Because of that, the bank says, I don't care how much you're charging. I want my lousy 6%. Pay me 6%, pay me a point, pay me something along those lines, I'll get my money back first. So before I use the examples to see what the returns go to, there's another piece of the puzzle that's very, very important. On an A loan, what happens is an A-B loan, is that this is the scenario typically how it will go down. Larry makes a loan for $700,000 for 1 year. He goes to a bank and says, participate with me for 1 year. What happens at the end of the year? Brian says, I'm having trouble with my building. I can't refinance that. Can I get an extension, Larry? Larry would love to give him an extension. He still believes in the property. Property went up in value. He wants to work with him. Or, no, there's actually a problem. There's a problem on the property now. And the guy goes, give me time to work it out. If I sold today, I'm going to lose all my money. And he says, I can only pay you, Larry. I'm going to pay you $650,000 if you took your money now. So What happens is they start getting into an argument. The bank knocks on Larry's door and says, hey, I'm your lender now. I lent you against your loan $500,000. I gave you a 1-year term. I haven't agreed on any extensions. I want my money back now. This building was worth $1 million. Now he's only offering you $650. If we wait another year, I'll lose money also. I want out today. So Larry's in a bind. This is the negative part for Larry. But Larry's in a bind. Larry, at this point, he's stuck in the bind. What does he want to do? If Larry wants to agree today to lose $50,000, then he has to agree to the settlement. Or if he doesn't want, he wants to fight it, and the bank doesn't want to stay, he's going to have to come up with a new $500,000 to pay off the bank in order to continue the fight. So if you think about it, I'm the lender, I'm the A lender in this deal, I'm the bank, I'm in a safe position. Because at this point, Larry doesn't want to get wiped out, and if he thought he could win it over time, he'll go and take me out. And if he takes me out of this loan, I'm safe now. He'll go fight it for the next 5 years. The odds of an A lender taking a loss, in my opinion, is nil to none. And more importantly, is that there's a much bigger chance it won't get to the fight because Larry's not going to let it go to the end. But let's say at that point there is a fight. The mechanics to foreclose within the same loan is like a partnership structure. So it's not a whole fight for the A lender to foreclose on Larry. If Larry can't live up to his terms, the A lender takes over Larry, forecloses on Larry first. Now Larry's wiped out. The A lender only has $500,000. That's all he cares about is controlling a $700,000 piece. So now Larry walks off to Brian and says, what was the offer you made? He was fighting with you? Oh, $650, but now I'm down to $600. No problem, I'll take it. They only have $500,000 to protect. The B guy's out. So you're listening to the story. If you're the B guy, it's more risky. On one hand, well, not. I'm showing you the nightmare side of the story. But let's remember, before you got to this slide, you all believed that 70% was a safe loan. I'm just giving you the mechanics. What if there's a problem going on? So here's how it works. On the A piece, B piece, hard money lending, same loan, $700,000, 12%, 2 points. Larry lends $50,000 of his own money. Larry takes $500,000 of an A loan from a bank. Larry pays the bank 6% at 1 point. Now, this is the conversation to imagine that Larry has with his 13 investors that were about to come into this loan. Say, guys, there's a change of plans. You're going to come in, you're going to pay 10%. Here's the story. I have good news and bad news here. The good news is, good news, bad news, good news. The good news is that it's the same $700,000 risk. I'm in for $700,000. We believe we're never going to go down more than 30% in this market. We'll cover. The bad news is, if there's a problem, we're going to leverage our loan. So therefore, if there's a problem, only the 4 of us together will take a loss. So that's a bigger risk, even though you believe you're not going to have a risk. But if there's a problem, that's the bigger part of it. Number 2, he tells him. Number 3, he says, but the benefit is because you're taking this extra risk, I might just go up higher in the loan to value, but just be willing to take second position. I'm in control of the fight, but second position, I'll pay you, instead of 10%, I'll give you 12%. And I'll give you 1%. I'll give you 1 of my points. So if you believe before you made this phone call to you that this deal is really a good deal, then we're in a great situation throughout the process of this time anyway. I think I have a great deal. Everything's amazing anyway. And now you offer me 12% because if there's a problem, I might get my money back second. I couldn't care less. So that's the dialogue. In this scenario, look what happens here. Larry got a same loan. A bank was able to place money, a very safe loan at 6% instead of maybe 4%. 3 investors are making 12% instead of 10%. And Larry is making off like crazy, the same deal. $98,000 is going in. $35,000 goes to the bank. $19,000 to the participants. $43,000 goes out to his profit on a $50,000 piece he put in. He went up to 87% of his money. So now I want to explain to you something that's going on in the hard money lending market today. Before you saw this presentation, if I told you that there's 2 people making a loan, this guy's charging 12%, this guy's charging 9%. You're going to walk away and say, 12%, can't believe would take advantage of the guy? This guy's a nice guy, 9%. If this guy's 12% came from money, from even partners, he made 12% on his money. If this guy took an A piece, B piece, participated the whole thing out, he did the loan on his 9%, he could have been making 20, 30% of his money. So he just passed on some of the savings. But who made more money on the deal? It's not just the surface, 12%, 9%. It's behind the scenes how they leverage and structure that transaction on the deal. So what's been going on right now is the first people that understood A piece, B piece financing, the first people that went into this field, they're making a killing. The market was charging 12. They had all these cheaper funds to get the money in. Today, there's competition. People understanding A piece, B piece. So now as an Eastern Union, not the Ira Group. The Ira Group's introduced individuals to loans. Eastern Union, we have lenders coming to us and saying, Ira, could you give me a bank that will give me a line against all my hard money loans? Give me an A piece for all my loans. They're passing along the savings, some of them. They pass along the savings and say, listen here, take this deal. Let's say in this case, he would have went back, Larry would have went back to Brian and said, Brian, I'm doing a whole A-piece, B-piece it. I'm only going to charge you, instead of 12 and 2, I'm going to charge you 12 and 1. Save you $7,000. So he went from 87% in the 70s. He could have gone down to 9% and still made a very, very nice return on what's considered a relatively safe loan. 70% of the purchase price. What are your choices with money? So the most important thing you have to take into account is inflation. Because if you just sit there and you don't make a high return than your money, then inflation, your money's going backwards. So the low returns, under your mattress, 0%, it's the safest, less than inflation. You can argue it's not the safest, you could have a fire, or you could be robbed, but that's where it is. Deposit money in the bank, 0, 1, 2%. FDIC insured, very safe. One thing I want to tell to everybody, if you're already keeping your money in the bank, that's what you're doing with it, you might as well go online and find the bank that's paying the highest rates and just wire your money over to that account. Why would you keep it in a bank anyway? It's only paying you 0 or 1. Gotta be crazy. Go shop for the best rate anyway. If you are FDIC insured, that you're looking for, go for the best bank. Participate in an 8-piece, backed up to 50% loan to value. Find somebody that's doing a loan and say, hey, can I participate directly with the hard money lender? Maybe he'll pay you 6, or go to someone who's putting these loans together. And I believe in this market today, as people are starting to find different levels of risk. What I'm telling you here today, I didn't invent, is that this was a securitization market. It usually happens on billions of dollars of deals at a time. What's happening because of technology and the ease of transactions is allowing it to happen on a building by building basis. And you can take a little loan and break it up into different pieces on that one transaction. The next thing up from there, high returns, mutual funds, stock market, or crowdfunding platforms like Yale Street. Typed it wrong, it's yalestreet.com. So on the Yale Street is that he has these online platforms. You go to a place like Yale Street, go online. You could decide to put $20,000, $30,000 into loans. They pool loans through all different types of loans. It's the concept of crowdfunding. It's just like you thought of crowdfunding for buying, there are platforms for lending. Participate in the full loans, 8 to 10%. You want to go even with everybody, make 8 to 10% probably is what you can make on your money. Participate in V loans for real estate, 10 to 12%. Participate in buying and syndicating, you're probably making 12 to 25%, but that's that risk reward tolerance if that's what you're interested in. If you syndicate lending, you can make up to that height. So thanks for joining. There's 2 parts when walking out. For those that want to look to participate in loans, no obligations, there's no fees, there's no deposit, there's nothing going in. You can fill out a form on the site. And as lenders want to start making offerings, I'll send out those offerings to you. And if you end up becoming successful and you invest with them, you participate in the loans. If there's a fee to be earned, the fee is paid by the lender, not by the participant side. If you're a participant, you're the flip side of the marketplace. You want us to find you participants, it's the same marketplace, to go the other side. If you have a regular deal you're looking for, you're a hard money lender, there's a takeout, something to work, then anyone from within Eastern Union itself is any broker. And the 2 that work exclusively on my own team, my own deals, is Michael Wine and Steve Cohn. I want to thank you very much. I'm going to stay here now to answer questions. Those that came here in person have business cards on the way out. And someone wants to start with some questions here. And then online, some people could start streaming, and we'll take it from there.